It is part of a bigger trend, which is absolutely about revitalization and reusing land and land uses that have really become out of date, bringing them back onto the tax rolls and generating productive sites out of what had been dead real estate.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. I'm pleased to be joined today by Matt Birenbaum, Chief Investment Officer at AvalonBay Communities, to talk about the multifamily REIT's development strategy. Prior to assuming his current role in 2015, Matt served as AvalonBay's EVP for Corporate Strategy. His 3 decades of experience in real estate development make him an excellent source for today's conversation. Matt, very pleased to have you on the podcast today.
Thank you for having me.
Starting off from a high level perspective, Matt, what are some of the major trends or themes that you see as most prominent in the multifamily sector today?
It's interesting to see how the demographics are influencing what gets built and where it gets built and the nature of that. And in many ways, it kind of reminds me of the beginning of my career in the 1990s. And that's really driven by the change to the demographics. We had the last 10 or 15 years, particularly the last decade, where we had the millennials coming of age, renting their first apartment, renting their second apartment. And it was a real renaissance for urban centers. And it drove a lot of infill development and a lot of smaller units, buildings with lots of studios and one bedrooms and lots of amenity spaces and mixed use and ground floor retail and people spending a lot of time in the neighborhood and in the building as well as in their apartment. But what we're seeing today is those millennials are aging. And in fact, the bulk of them are now moving into their 30s. And as that happens, they're coupling up. In some cases, they're having children. In many cases, they're looking for a little bit of a quieter environment, more living space to work from home, space to have the dog because the pets are a big thing, space potentially for kids. And so you're seeing that express itself in more migration to suburban locations and to larger format housing, whether that's BTR, which I know we'll talk about in a little bit, or whether that's just more 2 bedrooms and 3 bedrooms or 1 bedrooms and dens. And again, that reminds me a lot of actually what we were doing in the 1990s.
So let's look a bit more closely at AvalonBay's development strategy. You've already mentioned the build-to-rent space, so we can touch on that. What has attracted AvalonBay to invest more in that segment, and what role do you see it playing in your strategy longer term?
It really is about following the demand drivers. For us, what we saw was that, and what we continue to see is that as folks are looking for more space, a little bit more privacy, and as they're struggling to afford to buy a home because of what's happened with home prices and the overall monthly cost of home ownership, when you combine the sharp rise in home values with the rise in interest rates, with mortgage rates, more people are renting for longer and they are looking for that type of living environment. And in some cases, we can offer that through larger flats. And in some cases, we can offer that through various forms or configurations of either private homes or what I'll call is more of a home-like experience. And this is actually something that we were doing back in the 90s and all through the last couple decades as well. So we have some of this in our portfolio today. In some cases, they're townhome apartments. In some cases, they're stacked townhomes or they're direct entry flats or they're what they call big house flats. But they're all getting at that feel that's more like a house where you're not walking down a corridor and entering your apartment that way. And you're not likely to have somebody living above you and below you. Or if you do, it's only a little bit of intersection there, which provides more of that home-like experience.
Matt, given that about a third of your communities have a retail component, can you talk about why mixed-use development is important to Avalon Bay? Maybe touch on how you get the balance right between the components in that mix and how you're able to execute on this effectively, given the increased complexity that entails.
Yeah, now that is something that we've seen a lot of, maybe more so in the last 15 years than maybe what we'll see going forward. But you're right, about a third of our assets do have ground floor retail or commercial space, frequently in either urban or infill suburban settings. And some of that was driven by zoning and where the sites were located and what the local jurisdictions wanted to see. But a lot of it was driven by the environment. When you're building a mid-rise or a high-rise building that's fitting into an existing neighborhood with a fabric there, that can be and frequently is the highest and best use for the ground floor. And it's also, if it's done and it's well executed, really what our residents want. The convenience of being able to walk out your front door, in the building or across the street, down the street, and get access to the everyday necessities, whether it's grocery stores, drug stores, coffee shops, restaurants, fitness, not the fitness centers we provide in our buildings, which residents enjoy and use a lot as well, but boutique fitness concepts, third party concepts, all of those things, having that all in the building or within close walking distance has a lot of value to residents, really of all ages and stages. It is hard to get it right, but when you get it right, the whole truly can be more than the sum of the parts. And for us, this is an area where I think we do have a competitive advantage being a REIT because we are building and owning these assets for the long term. And so we can take a chance on that local owner operator of the ground floor commercial space. It's got a great concept. We can provide the capital for the build out, whereas a straight retail owner who's getting a bank loan is going to have a hard time getting that financed. In today's world, retail operators are having a really hard time getting that kind of capital. They've really been hurt by the rise in short-term interest rates. So we can provide our lower cost of capital to help get that space built out and get the right kind of operator in there. And the benefit for us isn't just the rent that they're paying, but really more what it does for the whole building. And that is one of the great benefits of being a REIT and having integrated approach, long-term ownership, capitalizing it on the balance sheet and not at the project level. But it is hard to get it right. And we hired maybe 5 or 6 years ago a head of our retail group who had come from a well-respected retail developer, owner, operator, Eden's. And so we really committed to it, to building a best-in-class retail group for a multifamily owner operator, because we've learned over the years, we certainly made our share of mistakes with some of our earlier mixed-use efforts. And it is a different business and a different skill set, and you have to respect that.
And so, how does the mixed use concept play into the whole idea of neighborhood revitalization? And how are you going about repurposing outdated former uses into new housing?
It's a big part of what we do. It's a big part of what we do every day. So, how does retail, and then I'll talk about it more broadly, it can be an important component, again, depending on the location. And there are plenty of infill locations where we are providing mixed use. There are a number of communities where we're partners with a retail owner, and maybe they're redeveloping an old shopping center into more of a pedestrian oriented format. And we're providing multifamily. In some cases, we're building the building and then selling back the retail at the base to the retail owner operator, let them do what they do best. We do what we do best. In other cases, we own the whole building. But it is part of a bigger trend, which is absolutely about revitalization and reusing land and land uses that have really become out of date, bringing them back onto the tax rolls and generating productive sites out of what had been dead real estate. I was looking at it recently. I think we have about 20 projects under construction today. At least two-thirds of them, maybe three-quarters of them, are repurposing of former outdated uses, many of them outdated suburban office. There's a lot of 2, 3, 4-story old suburban office buildings all across America, which are situated on large lots with surface parking that are just obsolete. And that's the office use that's dying today. The high quality Class A office, highly amenitized, those are actually doing pretty well. And that's an underappreciated story, which you do read some about, but people are increasingly understanding there's a bifurcation in the office world. But it's these older, functionally obsolete, relatively low density suburban office parks where we found a lot of success repurposing that, getting rezoning for multifamily. In many cases, it's mixed income multifamily with an affordable component as well as a market rate component. And it's bringing new life, revitalizing, as I mentioned, the tax base for these communities and bringing new residents. In those cases, frequently the mix of uses might be somewhere else within the business park by bringing new residents that in turn can provide a customer base for retail and service uses nearby. So that we're finding is more often than not the type of development sites that we're doing. We occasionally will develop a greenfield on the edge of town, but that's really not our stock and trade. Mostly what we're doing is these infill repurpose.
Matt, how is AvalonBay tracking in pursuit of the company's portfolio allocation targets, including your expansion regions and increased allocation to the suburbs?
So we set out a target. We've always historically been thought of as a coastal REIT, and that's still where 90% of our portfolio is. We have been focused on essentially the Northeast from DC up through New York, New Jersey, and Boston, and on the West Coast, Northern Cal, Southern Cal, Seattle. About almost 10 years ago now, maybe 8 years ago, we announced that we would start expanding into our first two expansion regions, Denver and South Florida. And then a couple of years after that, added 4 more expansion regions: Dallas, Fort Worth, Austin, Raleigh, Durham, and Charlotte in North Carolina. And our goal, we said at that time, was to get our portfolio from 100% coastal, which is where it was 10 years ago, to 75% coastal and 25% in those 6 expansion regions. We have a very big portfolio. We're the largest publicly traded apartment REIT. We have about 300 assets, 90,000 apartments. So it's a battleship and it takes a while to turn it. But I'd say we're about halfway there. As we sit here today, if you consider both stabilized communities and what we currently have under construction, we're about 12, 13% in those expansion regions. So we're about halfway on that journey to 25. And we're comfortable with that pace. We believe in kind of dollar cost averaging into these markets over time as we rotate capital and redeploy some of our portfolio out of the coastal regions into these expansion regions. And we're going to dollar cost average our way in, and that's what we've been doing. On a somewhat related note is the urban suburban mix. We've always been more than half a majority suburban portfolio, but if you go back a couple of years, we were about 70% suburban, 30% urban, and we would like to take that to 80-20. At the end of this past year, 24, I think we were 73-27, and we're continuing to make progress on that goal. So I would expect we should hit both of those targets within the next 3 or 4 years.
And Matt, looking across the portfolio, is there a particular development project from the last, say, 2 years that you think is particularly emblematic of the integrated AvalonBay approach?
Oh, there's so many that I could name, but I thought I would highlight, particularly as we're talking about how REITs work to revitalize land use in communities, a project that we completed last year in Montville, New Jersey. This is in northern New Jersey. It's actually on the banks of the Passaic River. And it's a great example of what we do and how we do it and how it benefits the communities that we do business in. Montville is the site of Avalon Montville was literally a junkyard and a crush plant. And it was where folks took old cars, whether it was car parts or whole cars that were crushed and essentially thrown into this pit and accumulated up over time. So for 50 years, folks had been leaving crushed, abandoned cars, car parts. The site was contaminated. It's in the floodplain and it's hard to access, but a prominent site off of a major highway there in Montville that was essentially had become an eyesore for the community and was a piece of property that with the right vision and capital could be put to a much more productive use. It also highlights our integrated approach with in-house development, in-house construction, in-house property management. We call it the asset team or the three-legged stool. This is a site that we started working on literally in 2013. So over a decade of figuring out the environmental issues, figuring out the geotechnical issues, fighting through the entitlements, which are never easy in these smaller jurisdictions. And at the end of the day, we just finally completed construction last year. So 11 years later, we have a 350 home community. We've restored the property. We've created a whole flood mitigation program to raise the site out of the floodplain and manage the floodwaters. We mitigated all of the contamination on the site. And we've got 15% affordable and 85% market rates, about 45 affordable homes and 300 market rate homes. And it's just been a tremendous success, both for us and our shareholders, for our residents, and for Montville and Northern New Jersey.
That feels like an amazing case study. I'd love to see pictures of that.
Oh, yeah. I'll get you some for sure.
And Matt, I saw that AvalonBay has targeted 110 million of portfolio reinvestment for 2025. What do you see as your main priorities in terms of allocating those funds?
Yeah, so that's really about investing in our current portfolio and the existing portfolio to drive better returns and continue to keep the portfolio fresh, young, and up to date. So we're always doing a certain amount of in-apartment home renovations, kitchen and bath renovations. We're always doing refreshes of lobbies and common areas and fitness centers. That's some of that. I'd say the things that are really growing are a couple of newer initiatives. One is in California, where a couple of years ago, the state legislature passed new laws that encourage the production of housing that will be what I'm going to call affordable with a lowercase a. So not rent restricted necessarily, but more affordable at a market rate. And the way they do that is they've allowed us to add apartment homes to existing communities by right without having to go through a very lengthy, drawn out, expensive entitlement process. It's called ADUs or accessory dwelling units. You may have heard of it for single family homeowners who build the granny backyard. This is essentially that applied to multifamily. And again, because of our integrated approach and because we have in-house development and construction and CapEx and operations, we're able to take advantage of this. And we have several hundred in various stages of the planning process. Many of these are taking outdated common area spaces that are no longer being used, like old laundry rooms that maybe were abandoned when we added washer dryers to older apartment homes, or maybe to an underutilized resident lounge that wasn't really getting much activity. So in some cases, we're converting those into apartments. They're typically small, 400 or 500 square foot, maybe 600 square foot apartments, which provides for a more affordable whole rent level. And then in some cases, you can actually build new build ADUs. In some cases, those are modular. In some cases, they're field built. So we're doing some of each of those. That's a big part of that increase to 100 million this year. And the other program that we've really been ramping up is our solar program. We've installed a lot of rooftop solar for common area, where basically the solar panels generate power to help drive our own utility expense, powering the lights and powering the lobbies in the hallways and the elevators. But now in some cases, we have enough roof space and enough sunshine in some markets where we can provide solar that will power actually resident apartments as well. It's complicated, it's highly regulated, but we are doing some of this resident solar, and it's great where it works. It can be a real win-win because we can generate electricity, green power, clean power, sell it to our residents at a price that's lower than what they would be paying if they were buying it off the grid, and make a spread on that for our investors as well. So we'd love to do as much of that as we can where it underwrites. And we are definitely growing that program this year.
Matt, looking ahead, what are some of the things that you're most excited about in terms of AvalonBay's evolution as a company, particularly in the development space?
Well, I just think we're seeing a lot of opportunity. One of the interesting contrasts is we're just coming off a period of time where we had record deliveries of apartments, market rate apartments across the US the last year or two. This year, last year, I think was an all-time high for units delivered, because if you go back a couple years before that, interest rates were almost zero. I would say capital was free, cheap, and easy. And the capital providers were not particularly selective. There were a lot of folks that developed apartments that didn't have the experience that we had, that didn't have the long-term view of ownership that we do. But now that world has changed. And now it's quite difficult to get new apartment communities financed. And you've seen starts drop materially. And we're really leaning into that. So as the rest of the market is shrinking, we're growing. So we're very excited that we're going to be able to take a growing share of a shrinking pie, which means we'll be able to A, get better subcontractors, get better pricing because they're less busy, and B, then deliver those homes into a market where there'll be less supply and they'll be met with strong demand. And that should equate to strong investment returns and a real competitive advantage.
It's a great place to finish things. Matt, thank you very much. You've been very generous with your time today.
Thank you for having me.
And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.